I've been profitably trading order blocks in supply and demand zones for more than 3 years now, and in this video I'm gonna give you an extremely simple, effective masterclass on order blocks, which will definitely be the only video you need to profitably incorporate order blocks into your plan. So here's what we're gonna cover. What is supply and demand, first of all, then what is an order block, then I'm going to give you some very specific and very easy rules and guidelines for order blocks so you know how to spot them and how to draw them. Then we're going to have a look at a little bit of time frames, so which time frames should you be using those order blocks on, and then of course we're going to dive into the chart to pretty much show you the thought process. So hope you're excited, let's get into it, and promise me that you're going to focus and watch all the way until the end. Now, we're going to start with the law that moves the market. And you probably know which law that is. It is the law of supply and demand. Now, let me quickly introduce you to that. What it is, well, as I said, it is essentially what drives all markets and determines an instrument's price or a product's price. When demand is greater than supply, which means that more people want specific things and more people are buying a specific thing, then of course prices will automatically rise to meet that demand. And when supply is greater than demand, which means that people are either selling or they're refraining from buying, so they're not buying, then prices will automatically fall, right? And this law operates pretty much on every single market. It's not just forex, it's not just indices, it's not just financial markets, it is also the prices that you get into your supermarkets, right? Do you ever wonder why you're getting discounts at the supermarket? Well, that is because there has been a very low demand for a specific product. Maybe it's very expensive, or maybe not a lot of people buy it. So then pretty much automatically that low demand, which is automatically means that there is a very big supply, makes prices fall, okay? And then that pretty much then motivates people to buy that product, which again increases demand. So this is why you're getting these sell-offs. This is why you're getting those discounts, because pretty much demand was very low, supply was very big, and they have to sell them off. And the way to do that is to literally drop the price. Okay, so just a funny story here. Now, what actually determines supply and demand? Now, we are traders, we're not looking for discounts in the supermarket. So for us, what determines that? Well, pretty much it's traders. But what do traders look at? Economic data, economic conditions, interest rate differentials, all right? So if one currency has a bigger interest rate and then the other one has a lot lower interest rate, then of course the demand for the currency that has a higher interest rate will be bigger, okay? Economic policies, again, the monetary policies, geopolitics, what is happening in the world, and a lot more. And even if we have a look at stocks and indices, maybe we have their corporate earnings for specific companies, the corporate results, revenue, financial attractiveness of those companies, the dividends that they're paying, the fundamental analysis, and price, of course, and a lot of other things, okay? But now this is just the theory and the very basic foundations. How do we actually put that onto the charts? So let's start leveling up and getting to where we actually want to go. Now, supply and demand on the price chart is usually interpreted as oversold, which again means supply is just running out and demand is starting to kick in, okay? Or overbought, demand is running out and supply is starting to kick in. So our task as traders is to identify at what zones price will be oversold in order to buy it or overbought in order to sell it. So that literally means we're buying low and selling high, which is how essentially profitability works in the markets. Now, this can be done through multiple ways. We have premium and discount ranges, the 50%, we have the Fibonacci retracements, we have imbalances, we have volume weighted average profiles, we have volume profiles, we have EMAs, RSI indicators, stochastic indicators, Elliott waves, and all different sorts of things. All of those technical analysis concepts are used to literally determine overbought and oversold. Where do you want to buy it and where do you want to sell it? Okay? But then the main principle remains the following. This is how pretty much looks like. This is the Wyckoff price cycle. We're getting into an oversold area. This is where demand starts kicking in. And as demand starts kicking in, we're having a push. And when, of course, we reach a top area, which is called the distribution area, this is where the market is overbought. And then, of course, we start selling. And usually on the price chart, it tends to look something like this. We start, we push, we reach a specific level where the market is right now pretty much overbought. And then of course the market starts going down where it's actually oversold. And then it just keeps repeating. If you look at any market, this pattern repeats at all times. The market is always going through that cycle. But you really don't need to know Wyckoff. You really don't need to know all of those things. All you need is a very simple edge that literally shows you what is low and what is high. So let's see what that is going to be for us in this video. So with the introduction out of the way, let's head for the real thing. Order blocks deep dive. What are order blocks? What do they actually mean? Because you have to understand the psychology behind these order blocks and how to pretty much draw them on your charts. So first of all, what are order blocks? And I want you to stick with me here because I'm going to explain my own understanding of what order blocks actually mean and how they work. And I really want you to understand this because this is the psychology behind order blocks. Okay? So banks and financial institutions, those are the big guys, all right, the big whales. They do not trade with one lot or 100 lots like us. They trade in thousands or millions of lots. We don't know what they're trading, but they're trading very big money. Okay? And as you probably know by now, trading is a zero-sum game. What that means is that in order for someone to win, someone else has to lose. In order for somebody to sell one lot of your USD, at the same time, someone has to buy one lot of your USD, and one of those people are gonna lose. That's just reality. That is trading. However, we as retail traders, we do not need to worry about the execution of our trades and about liquidity. However, those big guys, they must worry about that, okay? Because you cannot just go on the market and all of a sudden execute like 10,000 lots, okay? So I want to give you an example just to make you imagine what is actually happening. Bank X wants to place 1 million lot long on your USD. So what do they need? Respectively, they need 1 million lots shorts at the same time. So their order can actually get executed. So how can they actually generate those 1 million lots short? Well, they start tricking traders into buying and selling the market, generating the patterns we all know, double tops, triple tops, flags, trend lines, triangles, or sold sort of mess, okay? And they make it look good so that a lot of people will literally start buying and selling, and that is how they pretty much generate the liquidity. Do you always see that before a very big move, there is a consolidation, there is a little bit of a compression, there is a little bit of uncertainty, and then all of a sudden we get boom, the very massive big push, okay? Well, that's why. Because first they need to generate that liquidity. And after they generate that liquidity, after people are already in, then the banks will usually, before a very big move, they will launch a fake position to stop out older traders that have some orders in, okay? Because a stop loss order is immediately turned into the opposite order. So if you are having a buy position and you have a stop loss set, well, when your stop loss gets hit, your buy position turns into a sell. Because again, if you buy something and you hit stop loss, you gotta sell it. If you sell something and you hit stop loss, you gotta buy it back, okay? And then pretty much if enough people get stopped out, banks get their liquidity, and that is when they launch the move, okay? However, here is the very key thing about this one. They also launched that fake move to stop out older traders. So they're still running into some drawdown of that fake move. And this is why they're eventually going to come back to mitigate those orders at break even and then launch again with their own liquidity. So let me show you what that means in a schematic, okay? Here we have, for example, at this point, the bank X wants to buy 1 million lots. So what they start doing is they start generating some patterns. Double top here, sellers are entering, they're having their stop loss above. Double bottom here, buyers are entering, they're having their stop loss below here. And then before they actually are ready to make the move, they're going to make that fake move down. It's usually a very aggressive sell like that. And guess what happens? The stop losses of buyers here are being taken out. What do they turn in? They turn into sell orders. The bank wants to buy, so they need to buy it from somebody who is selling. So in that case, the stop loss of buyers are selling. We're also getting below here, we're getting stop orders. So sellers also entering here, sellers entering on lower highs as well. So we're getting a lot of sellers thinking that the market's gonna dump, and we have a lot of buyers hitting stop loss, okay? And then the market pretty much initiates that massive move, okay? However, Remember this fake move down. They had to sell in order to then buy. So imagine here they sold right there and they ran into some profit, but right now they're running into massive drawdown because their sell position is here, but right now the market is up there. So what they start doing is they start generating these same patterns, right? Sellers here, buyers here, stop out the sellers, trick the buyers, launch a new order lower, continue to accumulate until they actually make a new fake order like that into their previous one. So all of the sells that they had right here, right now, they're going to close them at break even. And when they close them at break even, okay, they immediately turn into buys. And this is exactly what they need to keep pushing on. So at the first time, they had to run into drawdown, but right now they're actually closing their trades at break even, getting more orders into the game, and right now they can initiate back up again. So that is the psychology behind order blocks. That is how it works, and you can literally see it everywhere on the charts. The market generates some lows, starts doing some trickiness, takes out the stop losses of buyers down there, and also starts triggering sellers. Okay, then again, you can see starts accumulating, really getting tricky. Then again, a very nice sell-off. Again, the consolidation, people looking to buy here, people already in sells, manipulation, stopping out all the buyers, and also continuing to trigger sellers. We got a little reaction, but then look at that. Finally, we have this very nice sell-off before the very big buy. So you see how much time they accumulated before they launched the big orders up? And these two sells here were their fake orders. These are those sell-offs to stop out all the buyers. So what they have to do, okay, they reach overbought, they take some profits, but then they have to return back to mitigate those losses here and to potentially add new positions. And when they do that, how do they do it? With another very massive sell to potentially trick against sellers, to stop out buyers. And then you can see eventually the market ends up rocketing. Okay, so that is the psychology behind order blocks. That is how they operate. So make sure you understand this, because again, you really have to be using something that you understand what it actually means. Now that you know what order blocks actually mean, let's learn how to spot them. So an order block is usually the last sell candle before a very big buy, as we saw, or the last buy candle before a very big sell. However, they can also be consecutive candles that also build your whole order block. So if you're having 2 or 3 consecutive buy candles, then that is going to be the order block. Or if you're having 2, 3, or 4 consecutive sell candles before a very big push up, then that whole thing is going to be your order block. Okay? Now, a little detail that you should be aware of is time frames, because an order block can be consecutive, let's say, for example, consecutive 3 or 4 candles on the 15-minute, but it could just be one candle on the 1-hourly time frame. So I'm going to teach you that later on, but you always have to also be observing the time frames. So here is how a bearish order block looks like. We're having a very big buy, the last buy candle before the very big sell-off. Okay, so this, in this case, this bullish candle is going to be our bearish order block or bearish supply zone. Okay, and here is the opposite example. We have the market pushing down. We're having a bullish candle, and then all of a sudden we're having this very big sell-off before a very massive buy. So the order block is going to be this very last sell candle before the very big buy. Okay, it's super easy, super easy. Now, I also told you that it could be consecutive candles. Well, here it is. In that case, we have a very similar example. You see 2 sell candles. We're having a little bit of an interruption here of that sell candles. We're having a pullback, and then we have 1, 2, 3 sell candles in a row. And then we're having a very big push up. Okay, so in this case, the order block is not this last candle. It is the last 3 consecutive sell candles. So you're literally going to take it from the top of the first candle that starts these consecutive sell candles. Here is a bearish example here. We have buy, then this interrupts the cycle. Okay, and then we have 3 buy candles before the very big sell-off. So in that case, we don't really take this little guy. It is the whole thing. These 3 buy candles before the very big sell-off. And if that is, for example, let's say the 15-minute time frame, if you go to a 30-minute or to a 1-hourly time frame, these 3 candles could potentially turn into 1 candle. Okay, so that is very generally how you drop order blocks. But right now, let's actually start having a look at some more detailed rules and guidelines. All right, so get ready to take notes because I'm gonna share with you two very simple and key rules for spotting order blocks, and I'm gonna give you the biggest order block mistakes that I've seen a lot of traders make, me also in the past. Now, order block rules and guidelines. I want you to remember something. In trading, it's all about keeping it simple. When I was studying order blocks, I was learning so many rules, man. Like order blocks should take liquidity. It should be in discount or premium. It should be followed by a clear engulfing candle. It should be a bigger body to wick ratio. It should be a 25% sell to buy or buy to sell. It should consider the order block 75, 50, or 25%. Like, come on. All of those rules, you literally get lost. So after a lot of work, I have literally defined two extremely simple rules for an order block to be valid. It has to break structure, okay? What sort of structure? I personally use for order blocks fractal highs and lows, but you can also use valid ranges. I can refer you to my drawing market structure in a mechanical way video. I'm gonna leave a card right now so you can watch that, but I'm also gonna show you what fractal highs and lows are. And second rule, it has to print an imbalance, or what is also known as fair value gap by ICT. Okay, I know a lot of you know about this. There are so many tutorials. I'm also gonna make one. Let me know if you want to see it. Okay, those are the two rules you need. It must break structure and it needs to print an imbalance. That's it. Nothing else. Okay, now you might ask, okay, do I take the wick or the body for an order block? Because a lot of traders preach that the real volume is within the bodies. A lot of traders can take the wicks as well. Well, that is your personal preference. I personally prefer taking it from the wick because it gives me a bigger zone and it doesn't make me miss trades. Okay, but indeed, essentially, usually the bodies are gonna hold the biggest strength. So again, I want you to back this to see what works for you. Okay, but we're gonna have a look at a lot of examples and we're gonna try to draw the difference. So again, take note of this. Two rules, nothing more. It needs to break structure, some sort of structure, and it needs to have an imbalance. That's it. So all you need to understand is these two things. So let me show you what fractal highs and lows are. Now, a fractal high is a high that has a lower high on both sides, and a fractal low is a low that has higher lows on both sides. So here is a fractal low. The market pushes down. This is the latest low, that is the lowest low, and if you check out to the left, it has a higher low. So that low is higher than this one, okay? So this is a higher low compared to the next low, and also this here is a higher low compared to the previous one. So this here is a fractal low. You can also, by the way, use an indicator, it's called fractals. It spots them automatically for you. And here is a fractal high. The market pushes up, it literally makes that top, which is the highest high, okay? And if you look to the left of it, it has a lower high. So the high of this candle here is lower than this candle's high. And then to the right of it, we're having also a lower high compared to the previous high. So lower high here, that becomes our fractal high. This is personally how I prefer looking at order block breaks. You can also look at valid ranges. You can also look at different types of breaks of structure. That is how I do it. It's very simple. It does not make you overthink because this one is very easy to spot and you can also use an indicator for it. Now, when it comes to imbalances, I know a lot of you are pretty much knowing how it works, but this is a 3 candle pattern, candle 1, candle 2, candle 3. And literally candle 2 needs to be a very big expansion candle. And the gap between candle 1's high, in this case, and candle 3's low is your imbalance or fair value gap, okay? So for example, if here we actually made that wick to cross that candle's high, there is not an imbalance, okay? But in that case, you can see the wicks are not overlapping, so that is a bullish imbalance. And here is the bearish one. Candle 1, 2, 3, the wick here of candle 1, which is the candle 1's low, does not overlap with the high of candle 3. So you're having that bearish imbalance. There is also indicators for imbalances, so don't worry if you don't know about them, but there are plenty of tutorials out there. You can absolutely get the very foundation of what an imbalance actually is and how it looks like. Okay? Now, I want us to start leveling it up a little bit before we actually get into the examples. Now, do you ever wonder why your order blocks are not tapping? I'm sure a lot of you are trading with order blocks and you get a lot of times where you just get missed on the order block and you wonder why. Well, Let me give you an extra rule. Avoid refining. If you have consecutive candles, I want you to take them all. Not just the last one, take them all. This is why the rule says it's either the last candle before the very big sell, if it's just one, or it's the last consecutive candles before the very big sell or buy. Okay? Because the majority of your missed trades happen due to you over refining, taking singular OB candles and trying to refine it way too much. So singular OB candles should only be taken when they're the last buy or sell candle and there are no consecutive sell candles. So for example, let me show you here. We have sell candle before a very big push. Now again, let's of course already start looking at the rules. Are we having a break of structure? Yes, that is a fractal high. You see we have a high and a lower high and a lower high here. That is a fractal high. The market is breaking structure. Does it have an imbalance? Yes, there is an imbalance here and also there is an imbalance here. Okay, so that is a valid order block. However, look at what price does. It pulls back and it starts pushing. And you are waiting for your order block to tap. It doesn't tap and you wonder why. Well, simply because you're over refining, and here is what you should do. Okay, because that is the real order block. It's the last two, in this case, consecutive sell candles before the very big buy that break structure with an imbalance. And look at where the market goes. It taps in and it keeps pushing up. Okay. Now again, here is the main question. Do you take it from the wick? So in this case, the order block from the wick is going to be that one. And from the body, you're going to draw it something like this. Okay. Now I personally, once again, prefer to draw it always from the wicks because that gives me again a bigger zone like this little zone like this. It's not going to make a very big difference. Okay. So just take it from the wick, be systematic. Your zones are very likely gonna tap, and if you then go to look for the lower time frame entry confirmations, you're gonna be very good. Okay, so avoid refining so that you can actually start getting your order blocks tapped and you can start getting some winning trades. Okay, now here is another refinement. Prioritize higher time frame order blocks. Now this is a step up for the over refinement problem, because sometimes the order block on one time frame is going to be way too small, but it's still going to be valid. Okay, or it's going to be way too high or way too low into your overall range. In cases like this, go up a time frame and find a bigger order block, because price rarely goes to the extremes. And I know in the past, like these extreme order blocks were very famous, with people catching like from the 1 minute extreme order block and catching like a 1 to 10 trades. This just doesn't work. It's just good on paper. I can come in right now, show you 1,000 screenshots on TradingView, how I caught 100,021 RR by taking a 1 pip stop loss from a 1 minute order block extreme. Doesn't work in the live markets. Okay. And usually price rarely goes to those extreme order blocks, because if it actually does, if you think about it, it's making usually a very big pullback, which is more than 70% of the range, and that is a bad sign. So if I just very quickly show you here, if you're having a very big, let's say you're having a buy and then a very big sell-off, and then your extreme is all the way up here, and you're looking for this to tap. Now here is 50%. This is where the market is usually going to pull back. Okay, and if it starts pushing and pushing and pushing it coming into the extreme, well, this is almost getting close to 100% pullback, which is literally going to make a trend change. So looking for those extremes, it's usually not a very good thing, because that means that new order flow, new bullish order flow is starting to kick in right here. Okay, so how do you battle with that when you have these very small order blocks? I'm going to show you right now. It is best to pick the bigger zone and ensure actually you get a tap of your zone, and then go look for lower time frame confirmations. Here's an example. This is, I believe, GBP USD on the 15-minute charts, and I'm just going to draw your attention to a couple of order blocks. Now, there are a lot more order blocks that can be spotted on this chart, but I'm just going to kind of get your attention to these few. Now, here is a very big extreme level here. That is a very extreme order block. Again, this is the last buy candle before the very big sell-off that breaks structure, and it has an imbalance. Does it tap? No. Even eventually it pulled back, didn't get tapped. Here, we're having the very last sale candle before the very big push with an imbalance that broke structure. Okay, the market pulls back. Does it tap that refined order block? No, it made a move up without you. Then we're having this very nice sell-off that breaks structure with an imbalance, and we have the last two buy candles, that is our order block. In this case, it almost tapped it, but still, if you were looking to precisely enter from the order block, you got missed once again, and the market flushes without you. Here, we're having the last buy candle before the very big drop with an imbalance that breaks structure. The market pulls back, it again goes without you. So what is the solution to those missed order blocks, which in this case, all of these order blocks are correct. They're not over-refined because literally all of them are the last sell candle, the last buy candle, the last buy candle, and here the last buy candle as well. There are no big consecutive order blocks. Well, you probably know by now you should just go up a time frame. Either be the 30-minute or the 1-hourly time frame and look at what we're having right here. Now, remember that extreme 15-minute order block? Well, if you just go to the 1-hourly time frame, you have 2 consecutive buy candles before the very big push with an imbalance that also broke structure. This here is a fractal low, so we're having a break of structure with an imbalance. Look, the market taps it, and that was the very big short trade idea. 15-minute bearish order block never got tapped. Now here on that very quick long into that 1-hourly bearish order block, remember the 15-minute bullish one? Well, guess what? 1, 2, 3 consecutive sell candles before the push that breaks structure to the left with an imbalance. Taps, gives you a very quick win, but your 50-minute bullish order block just stayed there alone. On the way down, we're having this very nice sell-off here, but remember our over-refined 50-minute bearish order block. Well, if you go to the 1-hourly time frame, we have 1, 2 buy candles. That is your whole order block. Now again, don't refine it to the last candle. It's the last 2, in this case, consecutive buy candles before the drop. Now again here, you can take it from the body if you wish. I always take it from the wick, usually. Okay, now the body in that case was a lot precise. Now here, if you took it from the body again, you maybe get missed. Here it's literally the body. Here it's the bodies as well. It potentially gets you missed. You're gonna find for yourself which one you like more. But again, back to the point, the market pulls back. Where does it pull back? Into the 1-hourly OB. It almost came close to the 15-minute, but if you're looking at the 1-hourly OB, you get a zone to trade from. Then the market dumps once again, breaks structure with an imbalance. Here is the last order block. It's the last buy candle before the sell-off with an imbalance that breaks structure. Now, in that case, we didn't tap that bearish order block. I think we came very, very, very close. We actually responded from the imbalance. In that case, this is why order blocks work amazing with imbalances, but hopefully you get the point. In that case, you missed 1 trade, you missed 2 trades, you missed 3 trades, and you might not have missed them simply if you went 1 time frame higher and you pretty much prioritized the higher time frame order blocks. Okay, so hopefully that makes sense. That is a very powerful rule that is going to give you a much higher win rate. You're going to get into more trades without missing them, and it's going to be amazing for you. Now, before we get into the timeframes and the charts, I just want to make a difference between order blocks and what I call base supply and demand zones. Because if you watch my weekly outlook and setups that I publish every Saturday, you're sometimes gonna see me draw these zones as well, and I call them base zones. Now, they originate from a very old method that I learned about supply and demand, that is rally base rally, or drop base drop, or drop base rally, or rally base drop. Okay, so for example, this base here makes a demand zone. This base here makes a supply zone. This base here demand, and this base here supply as well. Now, what is the very key difference between an order block and these base zones is that the base zones usually do not break structure. You're just having a push up, and then you're just having 1 sell candle, which is what I call a base candle, and then the market continues to push above it, printing an imbalance. Now again, an imbalance is always needed, okay? But in that case, you're having that sell candle and you're having an imbalance, but you don't have a structure break. Now, in a lot of cases, especially in trending markets, I will always take these kind of candles, because usually if you imagine this is your 1-hourly time frame, if you drop to a 15-minute time frame, there will be a series of sell candles and there will be a break of structure. Okay, so I still believe that this base supply and demand zones are pretty legit. Here, we're having a drop, we're having a base that is just, for example, 1 opposite candle, in that case a bullish candle, and then we continue to drop, printing new bearish imbalance. But if you look at it, there is no swing low, there is no fractal low, there is no structure break. However, once again, this to me is a base supply zone, which I'm still gonna be using because it has an imbalance. And if I drop to a lower time frame within this candle, there is gonna be a breakup structure. There is gonna be potentially a more refined order block. Okay, so just keep that in mind. These zones also work very nicely, and you're gonna see me sometimes draw them. So just because you don't argue with me that I drew an order block that did not break structure, this is because I also consider these supply and demand zones. Here's a funny question. What does a trader need? Well, a trader mainly needs two things. A point or a zone of interest, which is what we call POI, which is a hard time frame zone from which you believe price will potentially reverse from. And then what you simply need is an entry model, which is a confirmation that your POI is actually going to hold. And you pretty much need a way to enter from that POI. Okay? That's the two things you need. You need a zone and you need an entry model. That's it. Right? But a lot of us are overcomplicating it with 1,000 different concepts. Now, the main thing that differentiates these two things are simply timeframes. Because a hard time frame zone is going to be your POI, and then a lower time frame zone is going to be your entry zone. Okay? That's it. As simple as that. You need a hard time frame zone and a lower time frame entry model. And the market is fractal, as you know. So what happens on the hard time frames, the same thing is going to happen on the lower time frame, and it's going to have exactly the same power. So if you're looking for a hard time frame order block to look for a reversal zone, then you're going to go and look for a lower time frame order block to potentially take your trade from. Okay? Now you might have a question then, okay, Leah, what is high and what is low time frame? Well, that is going to depend on your style and your strategy. For some of you, a high time frame could be a 1 hourly. For some of you, a high time frame could be daily. For some of you, it could be weekly. All right. For some of you, a lower time frame might be a 1 hourly, but for some of you, a low time frame could be a 25-second. Okay. It really depends on your style and your strategy, but still, I'm going to give you some basic guidelines that you can definitely follow. Those are the ones that I follow. So let's have a look at them. Now, for me, monthly, weekly, and daily, those are my higher time frames. 4 hourly and 1 hourly time frame, those are my middle time frames. And 15 minute, 5 minute, and 1 minute, those are my lower time frames. Now, those are the only time frames I use. I don't do 30 minutes. I don't do 2 hours. I don't do 25 minutes. Those are the time frames that I use because it keeps everything systematic. Now, you have to use the hard time frames for your macro trend and direction. So if the monthly, weekly, and daily, you're bullish and you have a bullish order block, well, that order block on that hard time frame can be your macro reversal area. Okay, that is where you potentially would expect for the market to start reversing. But now, before you really look for an entry, you then need to use the middle time frames in order to give you a POI. Now, I use the 4 hourly time frame and the 1 hourly time frame for my POIs. So you see, I'm giving you a strategy here. Hard time frames to determine your overall trend. Middle time frames to actually wait and see if those two time frames are going to start aligning with the hard time frames and start giving you POIs to enter on that overall trend. So order blocks on the middle time frames are going to be your POIs from where you're going to start looking for an entry. And then guess what? You already know it. The lower time frames are for your entry model and entry zones. So order blocks that you find on the lower time frames are going to be the entry zone from where you're actually going to execute the trade. Okay? So feel free to follow these very generic guidelines, but that they're not generic. This is exactly what I use for my whole trading. Okay, so you can copy these time frames. And before we actually get into the charts, I want to give you a final remark. Okay, order blocks are just a tool. They are a piece of the bigger puzzle, a small part of a very big machine. So currently you're learning about order blocks, okay, but don't go on your charts right now and enter on every single order block that you see, because order blocks need to be within a system. You're going to need a top-down analysis. You're going to need to determine your bias. You're going to need to determine your draw on liquidity, where the market is going. You're going to need that hard time frame POI, lower time frame POI. You're going to need your entry model. You're going to need a management strategy, okay? But the beauty is that an order block, what I love about order blocks is that they can participate in all of these aspects of a trading strategy. As I explained to you, top-down analysis, if you have a bullish order block on the daily, well, you're bullish. Then if you have a bullish order block on the 1 hourly time frame, that is your zone. And then if you have a 15-minute or a 5-minute or a 1-minute bullish order block, then that is your entry. Okay? But again, order blocks are just a tool, and they work amazing when you combine them with market structure and with imbalances as well. So please try to utilize this tool in alignment with your overall edge and not on its own. Okay? And with that being said, right now it is chart time. All right, so I'm going to, before I jump into the charts, I just want to put this chart here and I want you to pause the video and try to spot all the valid order blocks that you see. I know you didn't pause the video right now and you're just staring, waiting for me to put it on, so pause it. Okay, I do hope you paused it. All right, I trust you. Here are all the valid order blocks, and this is how I actually mark them on my charts. I don't mark them with very big zones, I mark them with a line. So here, for example, you can see we're having a bearish imbalance. We're having a structure break of this fractal low. This was also fractal low, and this is also low. We're having this very big push down with an imbalance. So what is my order block? Well, it's the last buy candle before the sell-off. So how I'm actually gonna draw it is I'm gonna again take the low of that candle, not the body, because I don't draw them from the bodies, I draw them from the wicks, and drag it in space and just say, for example, that this is a 15-minute or a 4-hourly time frame OB. Okay, we're having a bullish push here that breaks a fractal high to the left with an imbalance. What is the order block? It's the last sell candle before that very big push. Now, what I have drawn here are the imbalances, and then the order blocks I'm gonna draw with just a little bit of a line. And you can see here, we pull back, we tap that bullish order block, we push up with an imbalance, breaking structure. So what is the order block? Well, look at this. It is not that very last sell candle, it is the last two sell candles before the big push up. So I'm gonna take it from the high here of the sell candle and drop it in space. The market taps in, reacts, but doesn't really hold. Now here, we're having this very nice push down. This is a fractal low, and this is also low here that we're breaking. Now here comes a tricky example. What is the order block? Well, if you have a look at it, we're having 1, 2, 3, 4, 5 consecutive buy candles before that push down that actually caused the break of structure. So in that case, this is an order block that I would very likely not use because it's literally the low here. Now you can take it from the body in this case, but this just does not make sense. However, in terms of our mechanical rules, the order block is from that low. Now, I would definitely prefer for the market to push below here and then come back to retest it. But in that case, we did not. And we pull back into the imbalance. We made a push down. Do we have an order block here? No, there is no imbalance. And then all of a sudden, we launch a lot of orders going higher, breaking structure with an imbalance. What is the order block? The last two consecutive sell candles before the very big push up. I take them from the high, so from the high of the order block, that is the first sell candle, drag it in space, the market taps in, continues, new structure break, there is a high that breaks structure. Do we have an imbalance? Yes, there it is. What is the order block? 1, 2, 3 consecutive bearish candles, take it from the high, drag it in space. Okay, it's not this last one, it's not this one, it's the 3 last consecutive sell candles that builds our order block, which gives you an overall bigger zone. And that zone has a very high likelihood of actually holding. Okay, so with that little tutorial right here, let's go on the chart and pretty much show you the process. All right, here we are on the charts right now on pound dollar. We're gonna start from a very high time frame, that is the weekly time frame. So there are 2 indicators that you can use. The first one is the fractals by Nephew Sam. This is gonna mark those fractal highs and lows that I told you about. And then you have the FVG by also Nephew Sam. If you don't know how imbalances work, that is an indicator to save you. I also have the Fanatic indicator for market structure, but that is not available publicly. Okay? Now, what is again the process of order blocks? Remember, break a structure with an imbalance. Now here's the first order block that I see. And how I'm usually gonna do it is, again, I'm gonna mark this potentially as a break of structure, which I don't have for the weekly time frame. So let's say that this is a weekly break of structure. Okay. Do we have an imbalance? Yes, we do. There is a weekly imbalance. So then in this case, we ask, okay, what is our order block? I hope you know by now. This is how I'm going to drop it. And I'm going to say weekly OB. And this is exactly what you're going to see me do on every single analysis on Saturday. Okay. So in that case, we're having the last 2 buy candles before the sell-off with an imbalance that broke structure. Okay. That is my order block. Now, if I take it just a little bit to the left, okay, we are also having here another weekly break of structure, okay, with a weekly bullish imbalance. All right, so do we have an order block here? So I'm just going to remove, maybe I should have started the other way around. If I just remove the previous one, where is our order block in that case? Well, you can see in that case, it is the last sell candle before the very big push up, okay? It's not from the top, because here we have bearish, bullish, and then bearish, okay? So in this case, this was the order block. So what I do, weekly order block, there it is. In that case, this one failed. Not always they're gonna work, okay? Then taking it a little bit to the left, what do you see? I see a very big weekly break of structure. I see an imbalance. So then I ask the immediate question, what is my order block? Well, look at that. 1, 2, 3, 4 consecutive sell candles before the very big push with an imbalance that broke structure. Well, guess what is the order block? There it is, weekly order block. And where a lot of you once again are going to do the mistake, hey, there is my order block, and you're going to draw it like that. Well, that is not the real order block. That is just a very big extreme level that a lot of times is not going to hold, because by the time the market comes here, it's already bearish and it's just going to potentially react and still break your level. Look at the precision. I didn't take it from the body again, because you can see if you take it from the body, you're once again over refining. In that case, the high taps, goes. Let's go a little bit to the left once again. What do we have? And keep in mind, this is the weekly time frame. We haven't even dropped lower. There we have a weekly break of structure. Okay, cool. Do we have an imbalance? For sure. There is the weekly imbalance. Okay, where is the order block? Well, let's zoom in. Sell, 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 sell. Okay, so we're once again having 4 consecutive sell candles. Okay, now look, in this case, the order block again will be this guy. From the high, that's it. All right. Because that is the highest high here. It's not this one, which is the first candle. This candle went above that previous candle's high, and then it still continued the sell-off. So my order block will be from the top. Now, in cases like this, okay, I'm just going to be real. This is where intuition comes in a little bit. I will also potentially consider the bodies. Okay, because you can see the market came in a little bit deeper. It also had that weekly bullish imbalance here. So yeah, in cases like this, you can see it went all the way to the extreme. So if you keep looking for extreme order blocks, in that case, you had luck. Okay, but based on my mechanical systematic rules, that will be my order block from that very top. Going a little bit to the left once again, just this is how I want you to practice. So I'm literally practicing with you right now. What do we have here? Oh, we have a structure break. Okay, let's mark that out. Weekly structure break. Do we have an imbalance? For sure. There is the weekly imbalance. What is the order block? Well, in that case, it's the last sell candle before the very big push up, because we don't have 2. Last sell before the push. Now, in that case, the market did respond from the imbalance, but not from the order block. But imagine this. There could probably be an order block, let's say on the 2 weekly time frame, that actually got responded from. Look at it. The last sell candle before the push, there is still that imbalance, but that is a 2 weekly imbalance. And then your order block is going to be from that high. Okay, so that actually got tapped. But again, we do not use the 2 weekly time frame. But again, a lot of times when you're having that small order block, you can go a time frame higher. But on the weekly, in that case, doesn't make a lot of sense. Here, once again, we're having a bearish weekly imbalance. Okay, where is the order block? Do we have a structure break first of all? Well, let's see. This is not a fractal low. Well, we have this one to the left. That is a valid structure break. Okay. What is the order block? Last 2 buy candles, taking it from the low. There is the order block. All right. Pulls back, gives a reaction, and then breaks it, which pretty much means we are going bullish. Okay. So that is how you practice, literally. Now, of course, if you right now are on a fresh chart, okay, and then, for example, right now, that is our weekly order block. We're looking potentially for that weekly imbalance as well, but we can see the market is running away. Well, we dropped to the daily time frame. What did we have on the daily? Very recently, this is actually a live trade that we took within the community. We had here a daily bearish imbalance that broke a daily structure, okay? And where is the order block? Well, it's the last buy candle before the sell-off with an imbalance that breaks structure. There is the order block, daily OB. The market pulls back, flushes. Currently, I might ask you, do we have an order block currently? We have a break of structure, and that is also the order block. Is that correct? No. Why? Because we don't have an imbalance. So that is not an order block, and this is where the power really kicks in, because you're only going to be taking high quality order blocks. Let's start making our way down to the quality time frame. Remember this daily imbalance and that daily order block? We're tapping into it right now. Now here you can see a very refined 4-hourly order block. This is where you can, of course, start using all the different time frames to your advantage for potential reaction areas like that. This is the last buy candle before the very big sell-off on the 4-hourly. That also broke structure. Okay, so that got tapped. However, here, for example, here we're getting a little bit of a supply and demand sandwich, a little bit of a tricky situation because the daily is bearish, but the 4-hourly time frame had this 4-hourly bullish imbalance that also broke structure. So what is the order block? Well, we can see we have these last consecutive sell candles, and if I drag them in space, look at that. There is the order block, imbalance, break of structure, the last 1, 2, 3, 4, 5 candles. The market taps in, beautifully reacts, but it fails to really follow through going higher. So guess what happens right now? It means that the 4-hourly time frame is failing and the higher time frame is starting to prevail. Let's see, what do we have? Here, we're having this fractal low that got broken with an imbalance. Okay, so there is our 4-hourly imbalance. Right now, we're starting to see the order flow actually shift in. And where is our order block? There it is. 4-hourly order block, the last buy candle before the big sell-off with an imbalance. We came close to touching it. Okay, now I can drop here to a lower time frame and we're still gonna find the order block. But we can see right now the market is starting to kick in. Here, once again, this was a fractal low that got broken with an imbalance. All right, 4-hourly imbalance. Do we have an order block? For sure we do. The last 4-hourly bullish candle before the drop that broke structure with an imbalance. Absolute precise tap, absolute nice flush. What else will we have? We have yet another structure break with yet another imbalance. Where is the order block? The last buy candle here before the sell-off with an imbalance that breaks structure. The market pulls back a little bit deeper this time before it once again massively drops. So do you see how many opportunities we just got on GBP USD this week? And I can keep going lower, okay? But right now, the lower we potentially go, the more refined it also starts to get, okay? Now, for example, here we have to be dropping to the 50-minute time frame to identify if we have a setup. Here, for example, you can see once again, this is the example that I actually showed you in the lectures, okay? There is that 1-hourly bullish, bearish, sorry, that got tapped, but if you refine to the 50-minute, it did not. Then there is, for example, this 1-hourly bearish. That was actually a beautiful trade idea because right now the 4-hourly time frame is aligned bearish and you got this 1-hourly bearish, taps in, that is your trade. Look at this on the 1-hourly time frame. 1-hourly bearish imbalance, where is your order block? The last buy candle, look at that, taps in, flushes. And again, here is where you have to start putting things into a system, all right? That is where you start putting things into a system because you can see from the weekly to, did we check out the daily? Yeah, we did. From the weekly to the daily to the 4-hourly time frame and then even all the way to the 1-hourly time frame, you are getting all of these order blocks, but you do not use them on their own, okay? Now, let me give you one more example of how I would freshly tackle a pair. Let me walk you through NZUSD, which was actually a beautiful trade. We had some executions from my private community members that are trading during Asia. So what do we have right here? Well, the very last thing we have is the first thing I usually look at is imbalances. Now we're having, for example, these 2 weekly bearish imbalances, but the market seems like it's running away. Okay, next thing, order blocks. We're having here a structure break, okay? So the order block is right there, but we can see that the market is currently running away. It is quite bearish. Now, I'm always gonna check what is happening to the left. That was also an order block that failed. Here we had this beautiful order block, these 3 sell candles that broke structure with an imbalance. There is the order block, tapped in, followed through, very good. But right now it just looks like we're bearish. Okay, so I am bearish biased. Then we drop to the daily time frame and let's see what do we have. Okay, now the very last thing that I see here, the very last imbalance that we have on the daily is this guy right there. That was quite some time ago. And we also have that beautiful daily bearish order block. The market tapped in, that was a beautiful trade. But then do you see any valid order block since then? Well, immediately no, because do you see any imbalances on the way down on the daily? No. Okay, now does that mean that I'm not bearish? I'm absolutely bearish. So I'm gonna start making my way down to the 4-hourly time frame and let's see what did we get pretty much yesterday. That was the trade that we took. Well, we had a little bit of a consolidation here on Monday, and then we had this very nice expansion lower that is breaking this structure. This is also swing low that we're breaking. This is also swing low. So we have the break of structure. Okay. Do we have imbalance? for sure. There's our 4-hourly bearish imbalance. Cool, where is the order block? There it is. So 4-hourly OB, okay? Now, here is a little trick that is it's not very advanced, but you might find yourself in situations like this. You get this 4-hourly bullish imbalance. What do I do? Right? Okay, do you have an OB in this case? And a lot of people will take something like that, which is a 1-hourly OB, sure. But on the 4-hourly time frame, do you have a breakup structure? No. Did this push up break any sort of structure? No. So this 4-hourly bullish imbalance here doesn't mean anything in the grand scheme of things that we're bearish. Now I have entry models based on failures of this one, but right now we're talking about order blocks. So we're getting into that 4-hourly OB and that 4-hourly bearish imbalance. I start making my way to the 1-hourly time frame to see, okay, how is price actually going to react from this kind of area here? There it is. Okay, now how we came in is we came in with this very nice 1-hourly bullish imbalance. We also had, for example, this 1-hourly bullish imbalance here that also printed this order block, which is what actually ended up causing that reversal here. Okay, so old order blocks and old imbalances, they do work. However, they are also just reaction areas. So in that case, the market gave a heavy reaction here and then it just continued to dump with the trend. Okay, but this is just me showing a little bit more advanced into the order blocks right now. We're not really going to look at that. Now we had this 1-hourly bullish imbalance. Okay, sure, the market pulls back. Does it continue to break structure? No, it just wicked it. No 1-hourly bullish imbalance was created. No 1-hourly bullish order block was created. What did we actually have is beautiful 1-hourly bearish right here. Does it break structure? For sure. There it is. And where is the order block? The last buy candle here before that drop. So there's our 1-hourly order block with the imbalance. The market comes in. Okay, so what is the next step? Well, we start dropping to the lower time frames. Now, in that case, I'm kind of going to give you a hint into the entry model. Okay, that was a short entry on the 15-minute, but we entered on the 5-minute time frame. So let me show you here. Okay, now we're tapping into that 1-hourly OB. We're tapping into that 1-hourly bearish imbalance. So what we're looking for right now, we're looking for the entry model. Remember, weekly and daily and monthly higher time frames, 4H and 1H getting that POI. In this case, we're trading, first of all, we're trading from that 4-hourly OB and the imbalance. Then we even over-refined it to see the 1-hourly time frame to also start aligning. And right now I'm on the 5-minute time frame looking for my entry model. Now, the entry model is already short here, which is my entry model. But let's say we want to enter with order blocks. Is this here an order block? No, it's not. Does it break structure? Does this move down break any sort of structure? Now, if you put the fractals on, is there a low that was broken? No, the last low that we have is this guy here. So this move down does not break structure, so it is not an order block. Okay, but look at that, the market pulls back, and then what it does, it then breaks structure with an imbalance, leaving, once again, that order block. So guess where your entry is if you want to trade order blocks? It is right here. Now, I wouldn't go... Now, the stop loss, again, I'm not going to teach you an entry strategy here, but usually don't keep your stop loss that tight. Just put it above that high. Just be safe. Give it some breathing room. All right. And then simply, me and my community go for very simple 2-hour trades. And that trade hits during Asia. Okay. Look at that. We went from weekly to daily to 4-hourly to wait for the 1-hourly time frame to show us the bearishness, for the 1-hourly order block to tap, for then to wait for a valid 5-minute order block here to print. We took the trade, had a safe stop loss. Now, if you did this, you'd still be safe. But again, I'm no longer trading stop losses like that. I just want to be safe, trading a bigger capital. I don't need 2-pip stop losses. There is the trade, all right? It hit your take profit. And then we had that very nasty reversal coming from that 1-hourly order block. But then eventually, we still ended up falling. And guess what? You can continue following with that trend. Unfortunately, here we just had that massive sell-off and then we kind of didn't really get any sort of clear entries. So in that case, the trade was this one. Okay, so I truly hope it's starting to make sense by now how I utilize order blocks. I gave you a lot of examples. I gave you very precise rules. And right now it's time for you to actually go on the charts, practice, build kind of a little strategy and incorporate order blocks to what you're already using. I have a lot more material on my channel that you can use to put something together. And don't forget to join my free school community where I also go more in depth into order blocks and market structure, where you're also gonna learn an amazing strategy. So let me know down in the comments if you enjoyed this video, if you learned something from it, and I'm gonna talk to you in the next one.